Welcome, ladies and gentlemen, to how we, as Orange Pty Limited, are planning on acquiring Apple.
So in this meeting, we're going to be discussing the accounting treatment of acquiring a subsidiary.
We're going to be answering a few questions on how we're actually going to treat this acquisition.
So I know that when we're preparing the consolidated financial statements after we acquire Apple, all the assets and the liabilities of both the companies must be in the consolidated financial statement. Why then do we not include the investment, the amount of investment that we've paid to acquire Apple in the consolidated financial statement?
The thing is that what we're trying to show on the consolidated financial statements is a picture of what Orange actually owns in Apple, right? So Orange currently owns the assets, the liabilities, and the equity, which is the net assets. By recognizing an asset in the consolidated financial statements, it actually says that you actually have an asset in yourself, and you can't have that. You need to present to the shareholders of the company that, hey, you guys actually have these amount of assets and liabilities that you got from company A, which is Apple Pty Ltd.
So Ayanda, goodwill is included in the consolidated statement of financial position of Orange as a group, but it is not included in the parent company, Orange, or the subsidiaries books, which is Apple. First of all, we'd like to know, what is goodwill?
Well, KG, goodwill is a type of intangible asset that arises when a company acquires another company. So when Orange acquires Apple, there are certain things that it's an internally generated asset that happens when maybe Apple has trained its staff properly or has good reputation and customer loyalty. So goodwill, because at acquisition it is designed to increase the value of the combined business. So when Orange acquires Apple, they're acquiring Apple with all those intangible assets that were internally generated. So that is goodwill.
So Ayanda, please explain to us how this goodwill is calculated then.
So when Orange acquires Apple, they acquire the fair value of the net assets in Apple. So the price, the consideration that Apple pays is more than what the net asset values of Apple are worth. So the difference between the two numbers is then what represents the intangible asset called goodwill.
So Ayanda, explain to me, why is it that goodwill is not recognized separately in Apple's financial statement or Orange separate financial statement?
As I had said before, that goodwill arises when one company acquires another company. So when Orange acquires Apple, the goodwill that we're paying for is somehow included in the amount of investment that we are paying. So that is why it will not be shown in the separate financial statements of company of Orange.
But in the separate financial statements, land is recognized at a value less than fair value, whereas in the consolidated financial statements, it's recognized at its fair value. Since it's the same land, why isn't it recognized the same?
See, the thing is, Dora, when Apple recognized its land for the very first time, when they got it, they recognized it at the fair value consideration, which was 30 million. This 30 million, they chose to recognize it at cost. Therefore, they cannot revalue it or have an amount higher than 30 million. When the group acquired Apple, when the Orange Group acquired Apple, they initially effectively bought this land for 33,050,000. That is why the land will be different. And now, Nicola, who's been in the United States working on the acquisition for a whole week, will now explain why there is a loan from subsidiary in the parent company's statement of financial position and why it does not appear in the consolidated statement of financial position.
Greetings, team from the US. Since Orange is a separate entity, there must be separate financial records for both Orange and Apple. Separate financial statements capture all intercompany transactions. The consolidated financial statements present an overall picture of the parent and subsidiary combined as if they were one entity. The process of combining Orange and Apple are known as the starting points. Then pro forma journal entries are the adjusting entries to eliminate any overlapping intercompany transactions, and in this case, the loan from Apple to Orange. So basically, the money just changed hands. Orange can't make a loan to itself, so the pro forma entries eliminate the risk of double counting and a significant misrepresentation of the financial statements. Thanks, guys.
Guys, thank you so much for taking the time to listen to us and our IFRS theories. And remember,
An orange a day keeps the doctor away.